Joining me is going to be Sabrina Unger, our Managing Director of Research and Strategy, who has prepared the House View along with Brittany Lupe, who both reside in our New York office. Joining Sabrina is Eric Cannon, our Managing Director and Deputy Portfolio Manager for our Value Fund, who is located in Philadelphia. Both Eric and Sabrina are actively involved in our investment committee and help shape our investment decisions, so we'll be able to get the benefit of their thinking of how we should be positioning our real estate portfolios going into this next cycle. And I am very excited to hear their thoughts. I want to begin with some commentary that I hope will help frame our conversation today. As we all know, we have had the winds at our back over the last 12 years, in which we have seen declining interest rates support our investment decisions in all asset classes, which has helped drive values of the stock market as well as the real estate market. Low interest rates have created exceptional investment opportunities during this period of time, and real estate has certainly been no exception. We also know that as inflation has raised its ugly head after several years of fiscal and monetary decisions, resulting in a wall of capital coming into the economy to try and reduce the pandemic-related risk of a very spooky economy, the Federal Reserve Board responded appropriately by increasing short-term interest rates starting in 2022 to try to abate those inflationary pressures, which unfortunately has resulted in this turbulence that we are all experiencing today in the capital markets. While we all know that we have hit a speed bump with higher interest rates, which has been pretty dramatic, we have not hit a brick wall, and those investors who know how to drive defensively in today's world are going to be able to navigate through this turbulence. We all, however, need to keep our seatbelts on very tight for the next 12 months or so, as we're going to hit some more volatility. I want to focus on several key themes that will help frame our conversation today. The economy is doing incredibly well. The consumer is relatively robust. Spending is up for both goods and services, and the confidence of the consumer is buoyant and optimistic. Unemployment is at record lows and demand for workers continues, but job openings are hard to fill. Wage growth has been robust, and there is more pressures on wages today with such low unemployment rate, and will continue with the workforce that is at capacity. While these are all positive, we believe that the next economic cycle is going to be a lot more volatile as we try to address inflation-related issues, rising federal debt, elections in over 45 countries around the world where there seems to be a strong populist bent, and the certainty in those elections is unknown, and as well as serious geopolitical risk and interest rate uncertainty. Interest rates are clearly tied to inflation, which is no doubt the biggest risk that we all face as citizens and investors. And while there are very positive signs that inflation is in fact abating, the strength of the economy has embedded within it the impetus for more inflation. All of us as investors want certainty and predictability, and we are very focused on finding the street signs which suggest a more even and stable path. While momentum investors have benefited from declining interest rates over the last 12 to 14 years, today active management and operational expertise are going to be one of the key drivers of values. Those investors who understand how strong hands-on management will impact strategy will more likely than not benefit from the opportunities that are going to be created over the next period of time. And finally, we believe the current reset in pricing of most real estate assets due to high interest rates, that there's going to be significant opportunities to be able to capture strong returns for those willing to make investment decisions to buy into a volatile market at a very attractive pricing metric on a relative basis. We all know that basis really does matter and that vintage year is important. These next few years will indeed be a generational moment where we are all going to look back and wish we had bought more. We are very optimistic about the opportunities that exist in for-rent residential, industrial, as well as necessity-based resale assets in the coming cycle. And both Eric and Sabrina will be talking more about that during our conversation. While office is a four-letter word today, we believe that even within office, there may be opportunities to be able to capture long-term value as office is not dead. And users of office space really do want to have a place for their employees, which is authentic and excites employees to be there. Whether that work is flexible or not is not the issue, but rather whether the workspace attracts the human capital to drive our businesses. We believe that there continue to be opportunities to acquire well-located, highly amenitized, experiential office buildings in markets where employment and population growth is occurring, and Eric will be unpacking that in more detail in a little bit. To help us unpack all of this in a lot more detail, we are going to have Sabrina share with us her thoughts about the macroeconomic factors impacting real estate investing in today's world and how we think about those factors in the context of positioning our portfolios for the future. We will then have Eric share with us his thoughts about the property markets and how we should think about portfolio construction for the next 12 to 36 months. We have already received some really good questions from some of those you're watching today, and we want you to feel free to reach out to any one of us through email or a phone call to ask any of the questions that you may have that are top of mind with regard to anything that you're thinking about. Sabrina, why don't you begin our conversation?
Absolutely. Thanks so much, Stanley. And I want to start by, I think, getting at, one of those questions that we've been asked a lot. It was being asked before the end of 2023. It's continuing to be asked today. And that is, when are we going to see the first Fed rate cut? When are they going to implement this pivot? And to tackle the question, I think you really, of course, have to look at where the inflation numbers are. This Fed has told us that they are data dependent. They're going to be looking at those numbers. If we look at December, the numbers showed headline inflation at 3.4%, which was actually a modest uptick from November, and it surprised relative to the consensus. So that's certainly not the general direction the Fed would like to be seeing inflation trend in. Again, 1 month a trend does not make, but you can imagine they're going to be watching that trajectory very carefully, as will we. There's a lot of other data that we need to factor in to try to figure out when that first cut might realistically materialize. We can look at things like the historical hike to pivot cycle. So how long has it taken in the past, once they've gotten to peak rates, for them to implement that first cut? Do we have, scenarios in the past that might relate to today? We can look at the state of the U.S. consumer relative to job market momentum, as you stated in your opening comments, things like relative financial conditions overall. But all that considered, and without getting into the weeds on all of those individual data points, I think we can expect to see first rate cut by mid-year. So, call it July, middle of summer. I think more important than when we have that first rate cut, though, is what happens after the rate cuts begin. And there, I think there's actually some good news to highlight, specifically for core real estate. What we've seen is historically Odyssey, which is the core real estate benchmark, the total returns for that benchmark have been positive 89% of the time in the subsequent 2 years after reaching a peak. So once we get to that peak rate, which I think we can argue we're there, we can start to see the light at the end of the tunnel for valuations and ultimately for total returns. So I'm more excited about what sort of happens after the first cut and maybe less concerned with pinpointing the exact moment that they're going to do it.
So we're talking about rate cuts. I mean, do we think that rate cuts are going to go back to where we were previously, where we had zero interest rate policy and where we were basically investing based upon momentum with no interest rates or low interest rates?
Yeah, I think while we would all love to see that a hyper optimistic scenario whereby interest rates go back to zero, it really brings us back to our prediction that this cycle is going to be marked by increased volatility. And it sets us up nicely to make that point, because markets have grown accustomed to prolonged easing periods. So not only did markets get used to interest rates effectively at zero for a prolonged period of time, but over longer periods of history, when the Fed has started to ease, they've done it for a fairly long amount of time. And I don't think that's going to be the case this time around. So there is something a little unique. Why don't we think it's going to be drawn out? Well, for starters, our starting absolute interest rates are still quite low. So if the average cut, over sort of an easing cycle is 400 basis points, and you're starting from 10%, that's much different than if you're starting from a 5% range. You can't cut over as long a period or as aggressively, because it does take you back down to zero. And we're going to get into it in a little bit, but there are some reasons to think that the Fed is certainly not going to be comfortable taking interest rates back down to zero, because there is the potential for inflation to come back in a more meaningful way. So We have a low starting point on an absolute level for interest rates, which means we can't have these prolonged cutting cycles. We're not going to get down to zero. And it's really being driven by these sort of structural drivers that could push inflation up. And the Fed really has to balance that idea of controlling for inflation without letting it get out of control and balancing that against a backdrop of generally slower economic growth. And it's really that balance, that precarious situation that we think fuels the expectation for greater volatility in the upcoming cycle.
So we have not had to talk about inflation and the structural issues over the last 12 years, 15 years. I mean, it's been a long time. And all of a sudden, we're now having to start pulling out our playbook from the old days and thinking about structural factors. So why don't you talk a little bit about what those issues are that are impacting the economy and what we have to be thinking about?
Yeah, absolutely. And I want to note too that, all of the news articles that are interpreting what's happening in inflation, on the month-to-month basis and the cyclical elements and expecting inflation to trend downward in the near term, there is agreement there. I am certainly not saying that there's anything wrong with those interpretations or that sort of short-term cyclical momentum or deceleration doesn't continue. I think it does. But what I think is getting less attention, and it's these components that could bring inflation back in a way that is stickier and less sensitive to the economic cycle. And it sort of falls into this nice mnemonic, right, which is the 4 Ds of structurally higher inflation and ultimately higher rates. So it's things like demographics and labor, to your earlier point, the job openings relative to availability, that is a structural situation that we have to account for. We're thinking about things like deglobalization and reshoring and what that means for goods costs, labor costs. So that can be potentially inflationary. We have costs associated with decarbonization and the green transition. So while we know that this is a positive over the long term, there are costs associated with taking these things into account and making building improvements. And finally, we have federal debt and deficits to be dealing with. So these 4 effective Ds of higher inflation, they're structural, they're embedded in the economy. Now, our House View document, which I think most folks on this call have received, really goes through each of these in greater detail. But the takeaway here is that while I think 2024 will be a year of declining inflation and modestly declining rates, I do think there will be a couple of rate cuts. Those 4 Ds are really poised to add upward pressure to prices and interest rates starting in 2025 and can carry beyond that. At the same time, as I mentioned, we have a backdrop where GDP growth has been, sort of slowing or weakening over decades. And that's true of advanced economies. And as an economy advances, you have less labor, the productivity, the potential for growth just tends to trend down. So again, we have this situation where there's a potential for inflation to come back against lower growth. We don't foresee that changing meaningfully in the next few years. So what it means for investors is that they should expect more frequent Fed policy intervention. And this is true both on the easing side as well as the hiking side. I think it's just really important to get across that they're going to have to balance inflation, keeping it controlled without completely throwing growth into reverse. And we have a lower trend line for growth as it is. It's going to create a cycle where you're going to see more tooling around the edges from the Fed, and that's going to create a cycle that is more fragile and I think more volatile, both from a GDP growth perspective, but also for interest rates.
So why don't you give us a little peek behind the curtain and tell us what you're telling investment committee about the future of real estate and how we should be positioning our portfolio today?
Yeah, I think it's safe to say that because we don't believe we get back to a zero interest rate world, that prolonged cap rate compression as a driver of total returns, the likes of which we saw much of the last cycle, that's not going to be a primary driver of returns. Historically, especially for core real estate, 80% of total returns were income, right? If you look over the last couple of years, it became increasingly more oriented towards appreciation, and much of that had to do with cap rate compression. I don't think that's going to be the driver. We really do have to focus on the income component, the stability of that, especially if you believe that we can have a more volatile cycle. And so what that's going to mean, from a practitioner standpoint, is it's going to come down to maximizing net operating income growth, enhancing operations. It's really a return to fundamentals. And that's what's going to separate performance, I think, going forward, is really just a commitment to operating these properties at an excellent, high level, and really taking a bottoms up approach to investing.
So this is a great point to pivot, and why don't we transition to Eric? And Eric, why don't you talk to us about the fundamentals that are driving the properties, and what you're thinking about the individual property sectors that we're investing in today?
Sure. Well, it certainly is the case that fundamentals across sectors are weaker today than they were heading into last year. That's largely due to the amount of supply being delivered into a period of moderating demand. And it's especially true in the residential and industrial sectors, though we believe conditions are expected to turn more owner favorable over the next couple of years. If start first with the residential sector, nationally, we are experiencing short-term oversupply, but there are lots of reasons to be optimistic about rent growth prospects moving forward. If you think about the alternative to rental housing, home ownership or for sale housing, and you compare conditions today to those conditions that existed really during the last deep value downturn or leading up to and during the GFC, conditions couldn't be quite different in the for sale housing or home ownership space. And back during the GFC leading up to it, you essentially had a speculative bubble in for sale housing driven by years of oversupply and lax mortgage lending standards. And the result was more than a 30% drop in housing prices. And that obviously made home ownership much more attractive compared to renting. The backdrop today, on the other hand, is completely different. You've had over a decade of structural undersupply of new housing construction combined with more restrictive mortgage lending and at higher mortgage rates. And so what that means is that renting today is much more affordable than owning, and you need probably about a 40% on average decline in home prices to get back on par with rents. And it seems unlikely, given conditions and how healthy they are from a supply-demand perspective, that a drop anywhere close to that type of level is in the cards. On the apartment sector, the oversupply problem is short-term. We believe it's going to improve. If you look at permitting as a predictor of future deliveries, we've already seen year-over-year declines more than double digits, setting up what we believe in the 2025 to 2027 period is going to be a very strong relative rent growth period. There will be some bumps in the interim, and that supply-demand imbalance could create a favorable window to deploy capital. Again, things vary market to market, and you can see that in certain markets, it could take a couple of years or more to absorb what's currently being built. And on the opportunity side, that could create selling pressures, we believe, in markets like, for example, Miami, Raleigh, Phoenix, and Nashville, as some of these owners struggle to survive this readjustment period of difficult operating fundamentals. And we are gearing up to pursue acquisition opportunities in this sector as they arise in 2024 and 2025.
I think we all agree that for rent residential in all its various facets is a great opportunity coming in the future right now. Why don't we talk a little bit about industrial? I mean, the Amazon effect is something that we read every day in the paper. Why don't you talk to us the impact of what's going on today? Because it's been a very hot market over the last several years.
It definitely has been. It's not as hot as it was in 2021, certainly. I mean, fundamentals are softer, but again, we believe that's a short-term problem. And if you think about, the last real value downturn being leading up to the GFC, call it 2007, 2008, industrial property conditions on the demand side are materially different than they were back then historically for industrial. Historically for industrial, rent growth was very limited. You had stable income, but your current income yield was a large majority of your overall prospective total return. and you really had limited appreciation. And the demand side for industrial is much, much stronger today. And we've seen large rental growth and appreciation. And why is that? Well, we've seen a proliferation of online shopping, and that has necessitated direct ship to consumer of goods and products. And those goods and products need to be housed somewhere, and they're housed in industrial warehouse distribution properties. Getting back to what Sabrina was talking about earlier with deglobalization and sort of reshoring, we've also seen a big push from U.S. multinational corporations to bring manufacturing and production back domestically. And sort of that was sort of unheard of back in the GFC period, where if you were a public company and you were telling your investors that's what you were doing, your stock was not going to be viewed very favorably because all the rage was to offshore manufacturing to lower cost locales. And we've seen a shift in that, and that's driving demand.
I was talking earlier about office, and I failed to mention that I should have given a parental advisory warning about the four-letter words surrounding office. But why don't you talk to us about what office is doing today and where the opportunities are, and what are the risks and how we should be thinking about it? I mean, there's just a lot of headline publicity on this.
Yeah, so despite your exuberance and optimism earlier, I mean, I'm not sure we'd put office in the same fundamentals position as industrial and residential moving forward, though it does seem somewhat of a bottom, whatever that is, could be coming into view by, call it 2026, as we look at various markets. Interestingly, when you hear from management teams of our tenants, there continues to be a focus on getting folks back into the office, staff that is 5 days a week. And ironically, at the same time, those same senior management teams that are surveyed, 43% of them expect the size of their office footprints to be reduced by more than 30% by 2026. So there are still headwinds and downward pressures. That being said, we are expecting that most markets will have moved through their bottoms, and the bottom at a basic level we're thinking about as the lowest point of occupancy and rents by the end of 2026. And that's not to say our expectations are of a V-shaped recovery and we're expecting things to bounce back quickly. We think there's a longer tail to recovery in the office sector, but there's virtually no new supply of space. And we are on more of a solid footing vis-a-vis hybrid work from home and work in office. And we believe that should help stabilize operating conditions over time.
That's great to hear. So let's talk about the new areas of investing that have come about over the last 4 years, 5 years. Niche investing, specialty sectors. Why don't you unpack all of that for us? Because it's a very big topic that we're all looking at.
Well, no question that these sectors are occupying a greater percentage of institutional portfolios, and in particular that of core funds, as office allocations and retail heavier allocations have been reduced over time. But these sectors are definitely not a one-size-fits-all solution, and we as a company in both funds tend to continue to favor the less operationally intensive, less CapEx intensive sectors, specifically single family rental, build for rent, and self-storage. We're really focused on distributable cash flow being close as possible to NOI and minimizing any leakage associated with CapEx costs. We actually think the case can be made that if you look at some of these specialty sectors that are more CapEx heavy and have higher operating costs, that if you look at the projected revenue growth through 2027 for some of these sectors, take for example senior housing, we think the case that can be made that the risk-adjusted return prospects are even stronger for traditional apartments than they are for senior housing, but without that added burden of specialized operating expertise, higher potential CapEx costs, and higher fixed costs.
A lot of people have been talking about office buildings being converted into and used for life science. Is that an opportunity that investors should be thinking about today?
We think that's a little overblown. On the life sciences side, as we've we've done a bit of it, but as we've, conversated with tenants in that sector, it really is a tale where purpose-built, brand new product, not dissimilar from traditional office, seems to be in much greater demand than an older converted suburban office park that a developer or operator thinks is now life science because its business plan for suburban office is dead at this point.
So that's probably a topic that we should be talking about with the questions. Maybe somebody will be asking about that. But why don't we just now move to portfolio construction? Very important. How do you wrap this up in a portfolio context for the value fund and when you're sitting and working with the investment committee on the core fund?
Well, I mean, as you alluded to earlier, and Sabrina stated in her remarks, the key is hands-on aggressive asset management, being proactive, not reactive in managing the portfolio, being ahead of the curve, recognizing where certain markets might be softening, and utilizing concessions to maintain high occupancy and maximize your cash flow. It really is about in-place NOI and keeping that as high as possible. Within the office portfolios, you need to be very creative in lease structuring and very flexible to your tenants' desires for optionality and expansion potential. We've had great success in that regard. And then, discretionary CapEx, we are highly scrutinizing and deferring or delaying those types of investments where possible. In terms of new investment opportunities, nobody can time a bottom. We think investors should be acting now to deploy capital over the next couple of years into structurally sound sectors, specifically residential, industrial, necessity retail, and the specialty sectors we're focused on. And we believe there's an opportunity to capitalize on these temporary supply-demand headwinds. We're emphasizing in-place income as opposed to appreciation potential. But by far the deepest part of our current pipeline in terms of new investment opportunities are situations to step in and resolve debt market illiquidity and debt maturity-driven shortfalls. And that can take many different forms. It could be outright wholly owned acquisitions. It could be recapitalizations where we're investing joint venture equity or preferred equity or even subordinated debt.
So to basically pull back on the phrase that we've heard about before, you can tell who is swimming naked when the tide goes out. That has certainly shown a lot of debt borrowers at very low rates having to refinance at very high rates. So how do you think about that today? Where do you think you would put money out in that market today?
Well, I mean, the wall of debt maturities is certainly an opportunity and a fertile ground for sourcing new investments. The maturity issues will vary property type to property type and borrower profile to borrower profile. The most distress you're going to read about in the headlines are going to be office assets in large cities, particularly lower quality office. But we're not really focused on deploying new capital in those sectors. I mean, there really is limited fundamental underlying demand to rent space in those and for tenants to be in those buildings. The other sectors aren't immune, though. We expect more debt maturity driven selling pressure in multifamily than we do in industrial. And we're seeing a lot of opportunities in that sector. And the reason is that there's a lot of multifamily that's owned by less well-capitalized private groups, private families, private operators who don't have equity to bring to the table when their loan is maturing. Whereas we've seen industrial become more heavily REIT and large institution owned. So definitely a lot of opportunity on the multifamily debt maturities.
Well, that is terrific, Eric. Sabrina, why don't you come back in and why don't we get to some of the questions that have been coming in because they're really terrific. One of them is that we talk about inflation. We know that goods inflation has dropped and maybe is even negative today. But at the same time, we're facing supply chain disruptions in Panama, the Red Sea, and the Suez Canal. All of this seems to indicate transportation costs are going to increase. How do you see this affecting overall inflation? Where do you think the Fed goes with this?
Yeah, well, that is a great question. And somebody is definitely keeping up on their news. So kudos to whoever came up with that question. I think let's focus on the Red Sea to start. That corridor, that shipping corridor, accounts for something like 12% of global trade. So not exclusive to the US, but global. And activity there has basically ground to a halt. You have seen vessel departures being diverted around the Cape of Good Hope, which is effectively the bottom part of Africa. That adds minimum of 9 days to a journey. Now, of course, we can say, well, time is money. Why is it getting more expensive? But that means that delays in goods, there's added fuel costs to transit that much longer. And so, at the same time, the Panama Canal can't pick up the slack because it's going through a drought. The Canal Authority there has reduced daily traffic by 40% relative to this time last year. So that's going to increase costs. And then just general geopolitical instability in the Middle East, yes, in those shipping lanes, but just in general also tends to drive up oil prices. So if all of these things are, a couple of them are sustained for a period of time, it does have the real potential to create some cost push inflation. The one, potential caveat or perhaps silver lining is that we have seen consumers shift their spending patterns. So earlier coming out of the pandemic, consumers were buying big ticket items and it was much more focused on goods, TVs, couches, new cars, new RVs. Now it's definitely pivoted more towards services. So that's more insulated in terms of impact from this, but certainly you could foresee a scenario whereby the cost push inflation of higher transport costs, longer time in transit begins to trickle into goods prices. So there certainly is a risk of inflation upside from these events.
Why don't we dig into this in a little bit more detail? I mean, service inflation seems to be rising and is in the 5% range year over year. We seem to be at full employment and we do not have a viable immigration policy. So how do we deal with this from a wage standpoint? Are you concerned about a wage price spiral occurring over the next several years? Or is this just doomsday thinking on my part?
Yeah, there seems like there's a lot of things to be concerned about when it comes to inflation, right? But again, if we learned anything after the pandemic, it's never say never. I think we face more risk from the cost push inflation from these geopolitical events and from supply chain disruptions than we do wage price inflation. And I'll tell you why, at least in the near term, right? So I think if we were going to see that, it really would have materialized, call it, end of 22 and maybe the first 3/4 of 2023. And that's because just the job availability, the job demand relative to labor was so tight, right? We really should have expected, and it probably fueled some of the inflation that we saw. We are beginning to see some signs of labor momentum easing a little bit. Now, certainly nothing to necessarily be concerned about, but we saw the December numbers just came out. Job openings are on a downward trend. So, still a lot of jobs out there, but it is softening. We are also starting to see something that I would suggest is a little more concerning, although it does sort of help with reaching labor equilibrium. And it's, just the number of layoffs that we're starting to see, in big companies. It's, Microsoft, Google, Instagram, Salesforce, and Amazon collectively have laid off 24,000 people just in the first month of this year. There was an article today in the Wall Street Journal that UPS is announcing expected layoffs of something like 12,000 people. So while we certainly don't like to see it, it does suggest that demand broadly is beginning to moderate. But to come back to your specific question about services, I think a key part of this discussion is immigration. It is a crucial part of solving for this because immigrants make up nearly 20% of the US workforce, and they participate in the labor force at a higher rate than actually citizens. So we want people to come in and work in our labor force. They also represent a high share of workers in service industries. So a viable immigration policy could help here. And again, we have an easing of job demand situation. So hopefully we can get to an equilibrium. But I think, again, never say never. I think we can avoid a true wage price spiral.
An interesting conversation for another time is whether we have the political will to be able to address an immigration policy, but I will leave that for the moment. Why don't we move over to transaction volume? Because it's been down by 60 to 70% over last year and this year, and that is an impact of higher interest rates and the inability to be able to obtain debt in this market. We all know that leverage is the mother's milk of real estate, and we have a limited amount of lending occurring in the marketplace. How should we be thinking about this and the impact on real estate investing? And is it really just interest rates, or is it certainty and predictability of what interest rates are really going to be?
Well, I'll take that one. I think both equity investors and lenders will become more comfortable to act with more conviction once interest rates stabilize. And knock on wood, as Sabrina said earlier, it seems like we're at that point. We've seen 2024 start off with good liquidity in the debt markets from life insurance companies, in the CMBS markets, and those underlying bond buyers, the government-sponsored agencies, specifically for apartments and residential, and interestingly, spreads have started to come in a bit as well. The challenge in the debt markets from a liquidity standpoint remains the banks, and banks make up a majority of the existing commercial real estate loans. And, money center, regional, and community banks are still, working through their own balance sheet issues. And we're not expecting much in the way of new lending from those types of lenders en masse, at least this year. They may work on selective new opportunities with big borrower relationships of theirs, but it's going to take a little while for them to work through some of their own balance sheet issues, get some repayments from existing loans, perhaps get some deposits back that left those banks before they start lending new capital again en masse.
We've received a great question on another macroeconomic theme. What are the biggest risk factors that will hit the surprise index that we should be thinking about as negative and or positive factors for the economy and real estate investing?
All right.
I think this is directed to you, Sabrina.
Yeah, I'll hit the negative ones. I wish I had more positive things to talk about. I think a risk is policy mistake, and it could go on either side. So it's whereby policy becomes too restrictive. So maybe the Fed keeps rates unchanged for too long a period. Inflation starts to drop really rapidly. That's a pretty dangerous policy mix. So that's certainly a risk. Or they loosen too quickly to appease markets and to sort of keep things moving. And then they have to retool if inflation retrenches, if this, if the wage price spiral becomes reality, if the cost push becomes reality. An interesting statistic is, sort of looking at what's happening on the wage growth front. Small businesses employ almost 50% of workers nationwide, and recent surveys basically are consistent with wage growth potentially reaccelerating in those businesses to 5% year over year by the middle of this year. So we, on the one hand, have a labor market where momentum is moderating. That should be more consistent with Fed policy, and inflation goals. But we can't ignore the counter signal from these small businesses because of such a huge share of the labor market they represent. So there's tension here on wage growth, on inflation, could come together and thwart the rate cut agenda that markets are really relying on. So I think that's a risk. I think another downside risk is just the geopolitical goings on and outright war. We have seen a prolonged situation with Russia and Ukraine. I don't envision we see an end to that, although we would certainly like to see that. We have, the war and the Gaza Strip. We have things happening in the Red Sea, conflict, increased polarization. And this is true, both on the actual war front, geopolitical, trade. It creates a loss of human life. It strains markets, elevates uncertainty. So those are risks. And we're in an election year, right? So there's always surprises that can happen there. The upside, I want to leave something on a positive note here. And an upside risk is that we see this immaculate disinflation continue and the Fed sticks this elusive soft landing. Seems to be that that's what markets are increasingly convinced of, which to me is sort of a risk in and of itself, that if it doesn't happen, markets are going to be disappointed. It's going to create a lot of volatility, but there is an upside chance that immaculate disinflation continues and we have a soft landing. So those I think would be the macro risks, both positive and negative.
So while the Fed is in a blackout period before tomorrow's meeting, why don't we just speculate here what we think is going to happen? Do we think that there's going to be any commentary about a rate cut, or is it just going to be more tells about the potential for the future and that there's too much embedded inflation that exists? Where do you frame this today?
Oh, this is a tough one. And I know, Stanley, this must have come from you. It's a great question. I think that they're going to leave their options open. I do not think that we are going to foresee any actual change in target policy rate. I think that they will maintain the tone that they had coming out of December, which is, effectively things are trending in the right direction. I do anticipate that they're going to allude to the headline inflation numbers that came out in December. They were above consensus. Again, not a ton, but they'll say, we're going to continue to monitor, be data dependent, allow ourselves the flexibility to cut when it's appropriate, but we don't want to do so prematurely. I suspect that's what we will see come out, but don't hold me to it because, of course, like I said, never say never.
Okay, one more question that's going to go to both of you. If you had $1 today, and it's obviously going to be a lot more than $1 necessary, but where would you be investing it today?
All right. Finally, I have something positive that I can talk about here. So I would certainly say, new investment dollars. I really do continue to believe in residential. There's a nice convergence of the cyclical elements that Eric outlined, the structural factors that are going to make investments made in that sector, called the latter half of this year into 25, 26, maybe even into 27, good investment vintages from the for rent side. Again, we have on the cyclical front, we have some oversupply being worked through. It's adding to some owners' capital pressures. It's going to create an opportunity to make a good buying basis. And then we stand to benefit from some of those more structural factors, unaffordable for sale market, lack of inventory. So with my $1 plus whatever else I'm being given, I'm putting it into residential.
That is true. Eric, any comments on that?
Well, I mean, what excites me is conditions have not existed for some time where you can acquire existing assets at a healthy discount to replacement cost, even existing multifamily and industrial, and more importantly, at an attractive unleveraged current yield. I mean, if you think about dating back to 2008, the Fed funds rate has been between 0 and 2%. So investors essentially had to take more risk and rely on leverage and debt to generate any attractive current yield, and that's not the case today. So that excites me. Secondly, I think service-oriented, necessity grocery-anchored retail is interesting and particularly well-positioned. There's been virtually no new supply of it. It's performed well, and interestingly, investors have been reducing their retail allocation, so it doesn't have as much new dollar investment interest as some of the other sectors.
Well, we want to thank every one of you, and I want to thank Eric and Sabrina for taking their time today to talk to us. And I certainly want to thank Sabrina and Brittany for their work on the House View, which all of you have received. And I strongly suggest that each of you take a few moments to read that again. It's well worth the investment of time on that because it's really a great presentation. So thank you all for participating, and we look forward to seeing you on future webinars. Thank you.